I am here to tell you today, in the plainest language I can muster, that following the crowd is one of the surest ways to stay poor. Not just to underperform the market, mind you, but to actually lose your hard-earned money, to watch your savings evaporate while you wonder what went wrong. When everyone is doing something, when something feels safe because of its popularity, that is precisely when you should be most afraid. I have watched the same mistake destroy wealth for over 70 years. It is not complicated. It is not subtle. It is simply this: people follow the crowd straight into financial disaster. They buy what everyone else is buying. They sell when everyone else is selling. And they wonder why they stay poor while a small group of independent thinkers gets rich. Today, I am going to show you exactly why herd mentality destroys your wealth, how the psychology works against you, and what you must do differently if you want to build real, lasting financial success. Let us get started. Well, hello there. I want to talk to you today about something that has been on my mind for quite some time now. It is a pattern I have watched repeat itself over and over again throughout my 70-plus years of investing. And I have to tell you, it never ceases to amaze me how people continue to make the same mistakes generation after generation. You see, there is this powerful force in the markets. It is not a new technology. It is not a revolutionary product. It is not even a particularly clever financial instrument. No, this force is much simpler and much more dangerous than any of those things. It is the herd, the crowd, the overwhelming human desire to do what everyone else is doing. And I am here to tell you today, in the plainest language I can muster, that following the crowd is one of the surest ways to stay poor. Not just to underperform the market, mind you, but to actually lose your hard-earned money, to watch your savings evaporate while you wonder what went wrong. Now, I know that sounds harsh, perhaps even a bit dramatic, but I have seen it happen too many times to sugarcoat the message. I watched it in the late 1,960 seconds with the Nifty 50 stocks. I watched it in 1999 and 2000 with the dot-com bubble. I watched it in 2007 and 2008 with the housing market. And I am watching it happen right now, today, in various corners of the market. The details change, the names change, the specific assets change, but the underlying pattern remains exactly the same. People see their neighbors getting rich. They hear stories at cocktail parties. They read headlines about overnight millionaires, and they think to themselves, I need to get in on this. I am missing out. Everyone else is making money, so it must be safe. That last thought, my friends, is the most dangerous thought in all of investing. When everyone is doing something, when something feels safe because of its popularity, that is precisely when you should be most afraid. Let me ask you a simple question. If you were buying a house, would you pay more for it simply because your neighbor just paid a high price for a similar house? Would you ignore the foundation, the roof, the plumbing, and the electrical system just because someone else was willing to pay top dollar? Of course not. You would want to know what you are actually getting for your money. You would want to understand the value of what you are buying. And yet, when it comes to investing, millions of people abandon this common sense entirely. They buy stocks not because they understand the underlying business, but because the price is going up. They purchase assets not because they have analyzed the cash flows, but because they are afraid of being left behind. They make financial decisions based on emotion and social pressure rather than on mathematics and reason. I have to tell you, this behavior baffles me. It truly does. We are talking about your life savings here, your retirement, your children's education, your financial security. And yet, people will spend more time researching which television to buy than they will spend analyzing a stock purchase. The crowd you see, offers a false sense of security. It whispers in your ear, if everyone else is doing it, how wrong can it be? It tells you that there is safety in numbers. It convinces you that you are not taking a risk because you are not alone. But here is what the crowd will never tell you. Here is the truth that gets drowned out by all the noise and excitement. Every single major market bubble in history was created by the crowd. Every crash was precipitated by the crowd rushing for the exits at the same time. The crowd is not your friend. The crowd is not going to make you wealthy. The crowd, in fact, is the very mechanism by which wealth gets transferred from the impatient to the patient, from the foolish to the wise, from the followers to the thinkers. Now, let me explain why this happens. Why do intelligent, reasonable people suddenly abandon their good judgment and follow the crowd straight off a cliff? Well, the answer lies in our psychology, in our wiring as human beings. You see, for most of human history, following the crowd was actually a pretty good survival strategy. If everyone in your tribe started running in one direction, you did not stop to ask questions. You ran too, because maybe there was a predator, maybe there was danger. The people who stopped to think it through, well, they often did not survive long enough to pass on their genes. So we have this deeply embedded instinct to follow the group. It kept our ancestors alive on the African savanna. But in the modern financial markets, this same instinct will absolutely destroy you. Let me give you a concrete example. In the late 1990 seconds, I watched as the entire investing world seemed to lose its mind over internet stocks. Now, do not misunderstand me. I knew the internet was going to be important. I knew it would change the world. But that did not mean that every company with .com in its name was worth billions of dollars. I remember companies that had never earned a single penny of profit trading at valuations that would have been absurd for even the most established, profitable businesses. I remember analysts on television explaining that the old rules no longer applied, that we were in a new era and traditional valuation metrics were obsolete. And I remember being called old-fashioned, out of touch, a dinosaur who did not understand the new economy. My partner Charlie and I, we sat there in Omaha and we watched this madness unfold, and we refused to participate. People asked me why I was not buying these stocks, why I was missing out on all these gains. And I told them the same thing I am telling you now. I said, I do not understand what I am buying, and I do not know how to value it, so I am not going to buy it. That answer did not satisfy most people. They wanted me to join the party. They could not understand why I would sit on the sidelines while everyone else was getting rich. But you see, I knew something they did not want to hear. I knew that prices that go up for no good reason will eventually come back down. I knew that gravity applies in the stock market just as surely as it applies in physics. And sure enough, when the bubble finally burst in 2000 and 2001, trillions of dollars of wealth vanished. Poof, gone. Retirement accounts were decimated. Life savings were cut in half or worse. People who had felt like geniuses just months earlier suddenly felt like fools. And they asked themselves, how did this happen? How did I lose so much money? The answer, of course, is that they followed the crowd. They let their fear of missing out override their common sense. They confused a rising price with increasing value, and they paid dearly for that confusion. Now, here is the really important part. This is not ancient history. This is not some dusty lesson from a textbook. This exact same pattern is playing out right now in various parts of the market. The names are different, the story's different, but the underlying dynamic is exactly the same. I see people buying assets not because they understand them, but because they are afraid of missing out. I see prices that have become completely detached from any reasonable assessment of value. I see the same euphoria, the same certainty, the same dismissal of traditional valuation methods that I saw in 1999. And I know, with the certainty that comes from watching this movie many times before, that it is going to end badly for most of the people involved. Not for everyone, mind you. The people who get in early and get out before the crash, they will do fine. But for the vast majority, for the people who buy near the top because they finally cannot stand watching from the sidelines anymore, it is going to be painful. You might be thinking, well, how do I know when something is a bubble? How can I tell the difference between a genuine opportunity and crowd-driven madness? That is an excellent question, and I am going to answer it. But first, I need to tell you about a man named Mr. Market. Mr. Market is a concept that my mentor, Ben Graham, taught me many years ago, and it is one of the most valuable lessons I have ever learned. Let me explain it to you. Imagine that you own a small piece of a private business. Maybe you and a partner each own 50% of a local restaurant. Every day, your partner comes to you with an offer. Some days, he wants to buy your half of the business. Other days, he wants to sell you his half. And the price he quotes you changes dramatically from day to day. On Monday, he might offer you $200,000 for your share. On Tuesday, he might want only $150,000. On Wednesday, he is back up to $225,000. His mood swings wildly. Some days he is euphoric about the business prospects. Other days he is deeply depressed. Now, here is the question. Would you let this partner's daily price quotes determine your perception of what your business is actually worth? Would you assume that the restaurant somehow became 40% more valuable just because your partner was in a good mood on Wednesday? Of course not. That would be absurd. You would look at the actual business. How many customers are coming in? What are the profit margins? What does the cash flow look like? You would make your own independent assessment of value. And you would only transact with your partner when his price was substantially different from your assessment. If he offered you way too much, you might sell to him. If he offered you way too little, you might buy from him. But most of the time, you would just ignore his offers and go about your business. Well, Mr. Market is that partner. The stock market is that moody, irrational partner who shows up every single day with a new price quote. And the mistake that most people make is that they let Mr. Market's mood swings determine their perception of value. When Mr. Market is euphoric and prices are high, they think everything is wonderful. When Mr. Market is depressed and prices are low, they think everything is terrible. But you see, the underlying businesses have not changed nearly as much as the prices suggest. A good business does not become a bad business just because the stock price falls. And a mediocre business does not become a great business just because the stock price rises. The business is what it is. The value is what it is. Only the price changes. Now, the crowd, they do not understand this distinction. They confuse price with value. They think that if a stock has gone up 50% in the last 6 months, it must be a better investment than it was 6 months ago. But in reality, it is usually a worse investment because you are now paying 50% more for the same underlying business. Let me put this in terms that everyone can understand. Imagine you are at a grocery store and you see that steaks are on sale. They are 50% off. Do you think to yourself, well, these steaks must be low quality because the price is so low? Or do you think, what a great opportunity to stock up? You recognize it as a bargain, right? But now imagine the opposite. Imagine the price of steak suddenly doubles. Do you rush to the store thinking, I better buy these expensive steaks before the price goes even higher? Do you assume that higher price means higher quality? Of course not. You probably decide to buy chicken that week instead. And yet, In the stock market, people do exactly the opposite of what they would do at the grocery store. They get nervous when prices are low. They think something must be wrong. And they get excited when prices are high. They think they are missing out on something good. It is completely backwards. The crowd buys high because everyone else is buying. The crowd sells low because everyone else is selling. And this is precisely why the crowd as a whole underperforms the market. They are buying at the worst possible times and selling at the worst possible times. Now, I want to be clear about something. I am not suggesting that you should automatically do the opposite of what the crowd is doing. Contrarianism, for its own sake, is just as foolish as following the herd. What I am suggesting is that you should think independently. You should do your own analysis. You should understand what you own and why you own it. And you should have the courage to stand apart from the crowd when your analysis tells you to do so. This is not easy. I want to be honest with you about that. It is psychologically difficult to watch everyone around you making money while you sit on the sidelines. It is hard to hold on to a stock that is falling while everyone tells you that you are wrong. The pressure to conform is enormous. But this is where wealth is truly created, not by following the crowd, but by having the discipline and the courage to think for yourself. Let me take you back in time for a moment. I want to share with you some stories from history, because if there is one thing I have learned, it is that history does not repeat exactly, but it certainly rhymes. And the more you understand about past manias, the better equipped you will be to avoid the current ones. In the 1,920 seconds, radio was the hot new technology. It was going to change everything. And it did, by the way. Radio truly was revolutionary. But that did not stop people from going absolutely crazy, speculating on radio stocks. A company called RCA, the Radio Corporation of America, saw its stock price increase by over 500% in just a couple of years. People were convinced that this time was different, that the old rules did not apply. And then came 1,929, the crash, the Great Depression. RCA's stock price fell by 97% from its peak, 97%. People who had thought they were building wealth were financially destroyed. Their mistake was not that they failed to recognize that radio was important. Their mistake was that they paid prices that made no mathematical sense, simply because everyone else was doing the same thing. Or consider the 1,960 seconds. We had what was called the Nifty 50. These were 50 large-cap stocks that everyone believed you could buy and hold forever. Companies like Polaroid, Xerox, and Kodak. Great companies, many of them. Companies that really did have strong businesses. But people bid the prices up to such absurd levels that even these quality businesses could not possibly justify the valuations. Stocks were trading at 50, 60, even 80 times earnings. Now, I have to ask you, does that make any sense? If you are paying 80 times earnings for a company, that means it would take 80 years for the company to earn back the price you paid, assuming the earnings stayed exactly the same. And of course, earnings do not stay the same. They fluctuate. They sometimes disappear entirely. When that bubble burst in the early 1,970 seconds, many of these Nifty 50 stocks fell by 70, 80, even 90%. People lost fortunes. And again, it was not because these were bad companies. It was because people paid ridiculous prices, simply because everyone else was paying ridiculous prices. Then we come to the late 1,990 seconds, which I mentioned earlier, the dot-com bubble. This one is particularly instructive because many of you probably remember it. Some of you may have lived through it as investors. I watched companies with no earnings, no profits, and often no realistic path to profitability trade at market capitalizations in the billions of dollars. I remember a company called Pets.com. They sold pet supplies online. Now, selling pet supplies is a fine business. People love their pets. They will always need pet food and toys. But this company was losing money on every single sale. The more they sold, the more money they lost. Their entire business model made no economic sense. And yet, the stock market valued this company at hundreds of millions of dollars. Why? Because everyone was buying internet stocks. Because the crowd had decided that anything with .com in the name was automatically valuable. Because people were afraid of missing out. They saw their neighbor double his money in 3 months, and they wanted in on the action. When that bubble popped, it was brutal. The NASDAQ index, which was heavily weighted toward technology stocks, fell by about 78% from peak to trough. 78%. Trillions of dollars of wealth evaporated, and once again, the people who lost the most were the ones who followed the crowd. The ones who bought at the top because they could not stand to watch from the sidelines anymore. More recently, we had the housing bubble of the mid-2000s. Now, this one was particularly dangerous because it was not just stocks. It was people's homes. It was the banking system. It was the entire economy. But the pattern was the same. Everyone was convinced that housing prices could only go up. People were buying homes they could not afford with mortgages they did not understand because everyone else was doing it. I remember people telling me that we had entered a new era, that the old economic rules no longer applied to real estate, that there was a limited supply of land, so prices had to keep rising forever. And I remember thinking, I have heard this story before. I know how it ends. And sure enough, when housing prices started to fall in 2007 and 2008, the entire house of cards collapsed. The banking system nearly failed. The economy went into the worst recession since the Great Depression. Millions of people lost their homes. Millions more lost their jobs. And it all started because the crowd convinced itself that prices could never go down. Now, I want to dig a little deeper into the psychology here, because understanding why people follow the crowd is the first step toward resisting that urge yourself. There are several powerful psychological forces at work, and every single one of them is working against your financial success. The first is something called social proof. This is our tendency to look to others for guidance on how to behave, especially in uncertain situations. If you walk into a restaurant and you see that it is completely empty, you might wonder if the food is any good. But if you see that it is packed with happy customers, you assume it must be worthwhile. Social proof works well in many areas of life, but in investing, it is a trap. When you see everyone buying a particular stock or asset, your brain interprets that as evidence that it must be a good investment. After all these people cannot be wrong, right? Well, actually, they can be, and they frequently are. The fact that millions of people are doing something is not evidence that it is smart. It is often evidence that it is dangerous. The second force is the fear of missing out. Psychologists have found that people feel the pain of missing out on gains more acutely than they feel the pleasure of avoiding losses. So when you watch your friends and neighbors making money in the market, it creates a powerful emotional pressure to join in. You do not want to be left behind. You do not want to be the only one not getting rich. This fear is so powerful that it overwhelms rational analysis. People will abandon their investment principles, their risk tolerance, and their common sense just to avoid the feeling of missing out. They convince themselves that this time is different, that the rules have changed, that they need to adapt to the new reality. But the rules have not changed. Human nature has not changed. And the mathematics of valuation have not changed. The third force is confirmation bias. Once the crowd has formed an opinion, people actively seek out information that confirms that opinion and ignore information that contradicts it. If everyone believes that a particular stock is going to the moon, then every piece of good news is interpreted as evidence supporting that belief. and every piece of bad news is dismissed as irrelevant or temporary. I have watched this happen countless times. During a bubble, you cannot find a single analyst willing to say negative things about the hot stocks. Everyone is a believer. Everyone has a rationalization for why the high prices make sense. It is only after the crash that people suddenly remember all the warning signs they ignored. The fourth force is recency bias. This is our tendency to give too much weight to recent events and not enough weight to long-term history. If a stock has been going up for 6 months, people assume it will continue going up. They forget about all the times in history when a stock went up for a while and then crashed. They focus on the recent past and extrapolate it indefinitely into the future. This is particularly dangerous because bull markets can last for years. People can make money following the crowd for a long time before the inevitable reversal occurs. And that success creates a false sense of security. It makes them believe that they are smart, that they have figured something out, that the old warnings do not apply to them. But then the market turns, and all those gains evaporate, and people realize too late that they were not smart. They were just lucky to be in the right place at the right time. And when the music stopped, they were still holding the bag. Now, there is one more psychological force I want to mention, and it is perhaps the most insidious of all. It is the narrative fallacy. This is our tendency to create stories to explain what is happening in the markets, even when those stories are completely divorced from reality. During the dot-com bubble, the story was that the internet was creating a new economy where the old rules did not apply. During the housing bubble, the story was that home ownership was the American dream and prices could never fall. Right now, in various parts of the market, there are new stories being told. Stories about revolutionary technologies, about fundamental shifts in how the world works, about why this time really is different. And these stories are seductive. They make sense. They are compelling. They give people a reason to justify the prices they are paying. But here is the thing about stories. They do not change the mathematics. A company is worth the discounted value of all its future cash flows. That is not a story. That is not a narrative. That is mathematics. And you cannot make a bad investment good just by telling yourself a convincing story about it. So when you are tempted to follow the crowd, when you feel that fear of missing out, when you hear all these compelling stories about why prices are justified, I want you to stop, take a breath, and ask yourself some simple questions. Do I understand this business? Can I reasonably estimate its future cash flows? Am I paying a price that makes sense relative to those cash flows? If I cannot answer yes to all three of those questions, then I should not be buying, no matter what the crowd is doing. So how do you resist the crowd? How do you maintain your independence when everyone around you is caught up in the mania? Well, let me share with you some principles that have served me well over the decades. These are not complicated. They are not secret formulas. They are simple ideas that require discipline to follow. The first principle is this: only invest in what you understand. I call this your circle of competence. Every single person has areas where they have knowledge and expertise, and they have far larger areas where they do not. The key to successful investing is to stay within your circle of competence. Do not venture outside of it just because the crowd is making money somewhere else. For me, I have always understood businesses that make and sell physical products. Insurance companies, banks, consumer goods companies. I understand how they make money. I can evaluate their competitive advantages. I can estimate their future earnings with some reasonable degree of confidence. So those are the types of businesses I invest in. Now, there are many types of businesses I do not understand. Complex technology companies, biotechnology firms, cryptocurrency. I do not understand how to value these things. I do not understand their competitive dynamics. I cannot predict their future with any confidence. So I do not invest in them, and I do not care if other people are making money in those areas. That is outside my circle of competence, so I stay away. This is crucial. You must have the self-awareness to know what you do not know, and you must have the discipline to stay within your areas of competence. The world is full of opportunities. You do not need to chase every single one. You just need to wait for the ones that fall within your circle of competence and that are trading at attractive prices. The second principle is to focus on price versus value. Remember what I said earlier about Mr. Market. The price is what you pay, the value is what you get. These are two different things. And successful investing is all about buying something for less than it is worth. Now, how do you determine value? Well, there are various methods, but they all come down to the same basic idea. A business is worth the sum of all the cash it will generate for its owners over its lifetime, discounted back to the present. That is it. That is the formula. Everything else is just details. So when you are looking at an investment, you need to ask yourself, what will this business earn over the next 10, 20, 30 years? And what is a fair price to pay for those future earnings? If the current price is substantially below your estimate of value, then you have found an opportunity. If the current price is above your estimate of value, then you should walk away, no matter what the crowd is doing. This brings me to the third principle, margin of safety. This is perhaps the most important concept in all of investing. It is the idea that you should never pay full price for anything. You should always leave yourself a cushion, a buffer, in case your analysis is wrong. You see, none of us can predict the future with perfect accuracy. Even the most careful analysis involves assumptions and estimates, and those assumptions might be wrong. The economy might turn out worse than you expected. A competitor might emerge that you did not anticipate. A regulatory change might hurt the business. Any number of things could happen. So you need to protect yourself by insisting on a margin of safety. If you calculate that a business is worth $100 per share, do not pay $100 for it. Do not even pay $90. Wait until you can buy it for $60 or $70. That way, even if your analysis is off by a bit, you will still make money. And if your analysis is correct, you will make even more money. The crowd does not think this way. The crowd pays full price, or more than full price, because they are afraid of missing out, because they are convinced that prices will keep going up. But that is speculation, not investing. And speculation is a loser's game over the long run. The fourth principle is to think long term. The stock market is not a casino. It is not a place to try to get rich quick. It is a place where patient, disciplined investors can build wealth over time by owning good businesses at fair prices. When I buy a stock, I am not thinking about what the price will be next week or next month. I am thinking about what the business will be worth in 10 years. I am thinking about the cash flows it will generate. I am thinking about how it will compound value over time. And I am perfectly happy to hold on to that stock for decades if the business continues to perform well. The crowd, on the other hand, is obsessed with short-term price movements. They check their portfolios every day. They panic when prices fall. They sell when they should be buying and buy when they should be selling. And all of this activity, all of this trading, it does not create wealth. It destroys wealth through taxes and transaction costs and poor timing. Now, let me talk to you about what it actually costs to follow the crowd. Because the damage is not just financial. It goes much deeper than that. When you follow the crowd, you pay a price in multiple ways. First, there is the obvious financial cost. You buy high and sell low. You chase performance. You pay too much for assets and then panic and sell them at a loss when prices fall. Study after study has shown that the average investor dramatically underperforms the market indexes, not because the indexes are so great, but because investors make terrible timing decisions. They let their emotions and the crowd mentality dictate when they buy and sell. I have seen estimates that the average equity investor earns returns that are 4, 5, even 6 percentage points below what they would have earned if they had simply bought an index fund and held it. Over a lifetime of investing, that difference is absolutely enormous. It is the difference between a comfortable retirement and struggling to make ends meet. It is the difference between financial independence and financial anxiety. But the cost goes beyond just the money you lose. There is also the cost of stress and anxiety. When you are following the crowd, when you are chasing the hot stocks, when you are constantly worried about what the market is doing, you are living in a state of perpetual stress. You check your portfolio obsessively. You lie awake at night worrying about whether you should buy or sell. You let the market's mood swings determine your mood. This is no way to live. Investing should not be stressful. It should not consume your thoughts and emotions. If it does, you are doing it wrong. When you invest based on sound principles, when you buy good businesses at fair prices and hold them for the long term, you can sleep soundly at night. You do not need to worry about daily price fluctuations because you know that the underlying businesses are solid. There is also an opportunity cost to following the crowd. When everyone is chasing the same popular stocks, they are ignoring thousands of other opportunities. They are not looking at the boring, unsexy businesses that might be trading at very attractive prices. They are not doing the work to find undervalued companies because they are too busy chasing the momentum stocks. I have made some of my best investments during times when the crowd was looking elsewhere. When everyone was excited about technology stocks in the late 1990 seconds, I was buying insurance companies and furniture retailers. Those investments did not sound exciting. Nobody wanted to hear about them at parties. But they made me a lot of money because I was buying value while everyone else was chasing dreams. And finally, there is the cost to your development as an investor. When you follow the crowd, you never learn to think for yourself. You never develop the skills and discipline necessary to analyze businesses independently. You remain dependent on what other people think, on what the consensus says, on what the talking heads on television recommend. But the path to real wealth, to lasting financial success, requires that you learn to think independently. It requires that you develop your own investment philosophy and stick to it through good times and bad. It requires that you have the courage to stand alone when necessary. And none of that happens if you are always following the crowd. Let me tell you something. Some of the loneliest moments of my career have also been some of the most profitable. There were times when I held positions that everyone told me were mistakes. Times when I refused to buy what everyone else was buying and was criticized for being out of touch. Times when I stood my ground while the crowd went in the opposite direction. And you know what? Those were exactly the times when I made the most money. Not because I am smarter than everyone else, not because I can predict the future, but because I was willing to do the work. I was willing to trust my analysis, even when it contradicted the popular opinion. I was willing to be patient and wait for Mr. Market to come around to my way of thinking. That is what it takes to be a successful investor. Not genius, not luck, just discipline, patience, and the courage to think for yourself. These are qualities that anyone can develop, but you have to make the choice. You have to decide that you are going to stop following the crowd and start thinking independently. You have to decide that you care more about being right than about being popular. You have to decide that your financial future is more important than fitting in. So let me bring this all together for you. Let me give you the bottom line, as clearly as I can state it. The crowd will always be there. There will always be some new mania, some new bubble, some new sure thing that everyone is chasing. That is just human nature. That is how markets work. And there will always be enormous pressure for you to join in. Your friends will tell you about the money they are making. The media will show you charts of prices going straight up. You will feel like you are missing out. You will feel like everyone else knows something you do not. But I am here to tell you that the opposite is true. The people who resist the crowd, the people who think independently, the people who have the courage to wait for real value, those are the people who build lasting wealth, not the people who chase the hot stocks, not the people who buy what everyone else is buying. The patient, disciplined, independent thinkers. Now, I am not going to pretend this is easy. It is not. It is psychologically difficult. It requires you to tune out an enormous amount of noise. It requires you to be comfortable being different. It requires you to have faith in your own analysis, even when the market is telling you that you are wrong. But here is what I can promise you. If you develop these skills, if you learn to think independently, if you focus on value rather than price, if you insist on a margin of safety, if you take a long-term perspective, you will do better than the vast majority of investors. You will not get rich overnight. You will not double your money in 3 months. You will not have exciting stories to tell at cocktail parties. But over time, year after year, decade after decade, your wealth will compound. Your portfolio will grow, and you will achieve financial security and independence. Is that not worth more than the temporary thrill of riding the latest bubble? Is that not worth more than the hollow satisfaction of keeping up with your neighbors? I think it is. I think building real, lasting wealth is far more valuable than the fleeting excitement of speculation. So here is my challenge to you. The next time you feel tempted to follow the crowd, stop. Ask yourself the hard questions. Do you understand what you are buying? Can you value it? Are you paying a fair price? Is there a margin of safety? If you cannot answer yes to all of those questions, then walk away, no matter what everyone else is doing. No matter how much you feel like you are missing out, walk away. And here is the beautiful thing. When you develop the discipline to walk away from bad opportunities, you create the capital and the mental clarity to recognize good opportunities when they come along. And they will come along. I promise you that. There are always good investments available to the patient, disciplined investor who is willing to do the work. The question is, will you be ready? Will you have the capital to deploy when everyone else is panicking? Will you have the courage to buy when the crowd is selling? Will you have the discipline to sell when the crowd is buying? That is what separates the wealthy from the poor. Not intelligence, not luck, but discipline, patience, and independent thinking. I am 70 plus years into this journey now, and I am still learning. I am still making mistakes. But the principles I have shared with you today, these are the principles that have served me well through decades of bull markets and bear markets, bubbles and crashes, manias and panics. They worked in the 1,950 seconds. They worked in the 1,970 seconds. They worked in the 1,990 seconds. They worked in 2008, and they are working today. So do not follow the crowd. Think for yourself. Be patient. Be disciplined. Focus on value, and build wealth the right way, one sound decision at a time. That is the path to financial success. That is the path to independence. And that is the path that will serve you well for the rest of your life. Thank you for listening. Now go out there and invest wisely.